Lastly, we go through an exercise where we walk through the accounting of an original issue premium. Just like in the simple exercise before we would deal with deferred taxes, we had an original issue premium, 5% coupon bond, issued at $10,445 with a face value of $10,000. So we had determined at that time that the implied interest rate was 4%. And we had gone through the work of identifying that the amortization was actually negative amortization, which means that it was an offset to the coupon payment. Right? So whereas original issue discount amortization reduces your pre-tax profit, this was negative amortization that was actually increasing your pre-tax profit. And this reflects on the balance sheet side the reduction every year of the principal balance until it gets to just exactly the $10,000 face value right before maturity. And so from a tax standpoint, it's really the reverse of what we've gone through in the prior two exercises, where the cash taxes that are due are not affected. The cash taxes that are due in the first 5 years are exactly the same as they were in the prior exercise, where it was a 5% coupon bond at an original issue discount. But the deferred taxes now are no longer deferred tax assets. They are deferred tax liabilities. Because what's happening here is from a GAAP tax expense standpoint, we are reflecting that we owe $232 million because of this interest income from amortization, effectively, which of course is an accrual-based concept. It's non-cash, but it is recognized as GAAP tax expense. The only thing we owe is $200. And this represents the fact, and this exists because we know that in the future, when this bond matures, there's going to be a gain from a tax standpoint. This bond is going to mature, and the company is going to have to pay $10,000 on a bond that, from a tax standpoint, has a carrying value of $10,445. Because only from a book accrual standpoint does the bond actually reflect that amortization to get to $10,000. From a tax standpoint, the bond stays at $10,445 at that original issue premium, and only once it matures is the difference between what the company has to pay to satisfy the obligation and the original issue premium is finally recognized, and that's recognized as a gain. The idea is I was able to satisfy a liability with a value of $10,445 for only $10,000. That represents a gain on the extinguishment of debt, the opposite of what we went through in the prior exercise, and that gain shields us from the sum total of all of these deferred taxes that are being recognized over the term of the loan from a GAAP standpoint. And so these represent deferred tax liabilities as opposed to deferred tax assets. It's often confusing for students for the first time going through deferred taxes to understand why is this a deferred tax liability as opposed to a deferred tax asset. And conceptually think about the idea that it's a liability because when this bond matures, we are going to have to owe taxes to the IRS or whatever the tax authority is that we haven't recognized from a tax basis yet. And so we are recognizing from a book basis every year the incremental liability that's created because of these timing differences between the book basis and the tax basis of the liability. So here, unlike in the prior exercise where we saw DTAs being created, this is that we need to actually modify this. So we need to modify that this is actually going to be zero. So every year this is zero. There's nothing happening to deferred tax assets. What the changes are happening in the deferred tax liability. Every time the deferred tax line on the income statement, there's a GAAP tax expense, which is a debit on the income statement. That's comprised of two debits now, as opposed to a debit and a credit before. It's comprised of a debit to a current tax liability that's a debit. The corresponding credit is the cash reduction, and then the other debit is the deferred tax liability that's created, and a corresponding credit on the DTL side. And so this is what we see, the creation of deferred tax liabilities, so that we get to the 178 by the end of the period and a complete reversal when the gain is recognized. And that 178 divided by the tax rate is exactly equal to the 445 difference between the face value and the book value and the original issue premium.